Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this Friday morning. Let's get to the three things that you need to know today.
First up, S&P 500 futures trading higher this morning as investors digest the latest economic data and earnings on the final trading day of February. Nvidia shares still under pressure today after closing down 8% following that mixed earnings print. That marks the worst post-earnings performance for the stock since 2018.
Plus, investors also assessing the latest read on PCE, the Fed's preferred inflation gauge, core PCE, which came in line with estimates showing inflation rose at a modest pace in January. However, personal income and spending surprising the street, with income gains topping estimates while consumers pulled back on spending.
And the Bitcoin sell-off continuing, with the digital asset plunging below that key 80,000 level, falling 25% from its record high. The downward price action comes as crypto investors gather for Bitcoin Investor Week as risk-off sentiment hits the industry.
U.S. stock futures rising after the latest econ data, and we got that fresh out this morning. The personal consumption expenditures, and ultimately this is the Fed's preferred inflation gauge. You're seeing futures actually moving higher by about 0.4% for the Dow, S&P 500. That's up by about 0.2% right now. And then additionally taking a look at the NASDAQ, that's trying to find its way. But it is, as the famous song would say, on my way here this morning, often not to the races, but flat, just trying to figure out what direction and what's to open up here 30 minutes ahead of today's opening bell.
Yeah, you've still got those big tech names, I think, weighing on the broader averages here, but that PCE print, let's zero in on that because month over month and year over year core coming in line with expectations. But the big surprise that we wanted to focus in on, you got income up, but spending down. And consumer spending has been part of what's made this economy so resilient. So if that is a trend that continues, that could be a concern for the Fed and, of course, for our broader economy. Is this a sign of an economic slowdown? You can see on your screen personal income up by 0.9%. That was mainly driven by things like farming, trading income, and even Social Security. So don't expect that to mean you're getting a raise anytime soon. But on this flip side here, you've got personal spending down by 0.2%. The estimate was for a gain of 0.2%. So that could be a sign here that we are seeing a little bit of a potential slowdown, and that could potentially lead to a little bit of concern for the markets, though it does appear that we are on track to recover.
Yeah, looking at some of the categories here as well here, because the $30.7 billion decrease in current dollar PCE in January, that actually reflected a decrease of $76.7 billion in spending for goods and an increase actually of $46 billion in spending for services. So that continues to spell out the strength in services spending that we're seeing in that pullback in goods spending. And which goods? Well, category by category right now, looking at motor vehicle and parts, that was the biggest decline that we saw during this most recent reading here. That was down by about $41.1 billion, it looks like here. And so all of these things considered, on the services side, it really is still housing, shelter costs, and utilities that are holding up the services spending on that side. That was up by $29 billion.
Yeah, and housing is such a critical indicator of how consumers feel about the economy. When housing's expensive, you don't feel great about the economic conditions. But let's recap. The Fed's preferred inflation gauge slowing as expected in January. Core PCE rising 0.3% from December and 2.6% on an annual basis. That is the smallest year-over-year change since 2021. Joining us now to discuss, Steve Rasciuto, Mizuho America's chief U.S. economist. Steve, great to speak with you here. Just want to get your reaction to the PCE print. Does this change your outlook for the economy? Do you see any more signals of slowness to come to the economy?
No, I really don't. And I think the key driving point here is that consumer spending was up over 4% in the fourth quarter of the year. So, and a lot of that was driven by goods. So to the extent that there is some correction that takes place in that to a more normal level of spending, it's really not a surprise. We saw a huge surge in auto sales in the latter months of 2024, and now we've seen a bit of a correction back in that in 2025. The underlying trend rate from services continues to be very, very solid, and that will dominate. There's also been this historical pattern since 2008, where basically you have a very robust fourth quarter and then a weaker first quarter. And when you average the two, you're still running above trend. And it looks like that pattern is going to continue in here. And the kind of income gains that you're seeing here, 0.9%, is critical. And when you say, well, that's Social Security, you have to understand, not only was there a bump up in Social Security that took place from a cost of living standpoint for a lot of America's retirees, there was also the transition that took place in terms of the Social Security Fairness Act, which increased Social Security contribution payments made out to government workers who receive government pensions. And I can assure you they're going to go out and spend that extra money, and I'm sure it'll be reflected in the February and March data as we go forward.
Steve, I guess what do you make of the consumer right now, considering the services weighting in spending that we're continuing to see? As of right now, it's looking like it's all areas and categories within that services that are needs, not necessarily wants. So that also spells out a consumer potentially that is saying to themselves, all right, in other kind of parts of the home, we're penny pinching, but in those needs, like we can't help it but to continue to spend into those services because they're critical.
Well, again, I disagree with the interpretation that they're penny pinching. I mean, I think the environment of a very robust fourth quarter on goods spending and then some correction in January, you went out and had a great Christmas season. So after that Christmas season, do you then have to go out and satisfy additional consumer-related spending on goods? Services drive the economy, and people are willing to pay higher rents and comfortable paying higher rents when they're receiving more in their employment and they're receiving more in the government subsidies that come to them. And it drives the economy forward. Are we going to see an economy in Q1 that is exceptionally robust? No, but are we going to see an economy when you average Q4 and Q1 is running above trend? The answer is yes. And I think we'll continue to run above trend throughout the entire year. You have to realize that the Biden administration on its way out the door spent upwards of $500 billion. The Federal Reserve cut interest rates 100 basis points in the end of last year. So we're just getting into the point where those interest rate cuts and that fiscal stimulus really begins to drive the economy in the first half of 2025. And I think we're going to see it as we go forward in through the quarter and pick up into the second quarter of the year. This is nothing more than a temporary dip in the data after an exceptionally robust Q4.
And Steve, perhaps we're painting a brush a little bit too broad here, because there certainly are some areas, cohorts of the consumer that are penny pinching right now, that have felt like they've been in a recession for the better part of 18 months, especially on the lower income side. And I believe you and I have spoken about that before. I guess the larger question on aggregate is, at what point would you be tracking some of these services growth that we're seeing, and whether that be on a percentage basis, on a dollar basis, whatever the case is, how that is keeping pace with, or wages, I should say, keeping pace with some of that service spending as well?
Yeah, well, when you've got a 4.1% unemployment rate and you're below the natural rate of unemployment, which is the frictional level of unemployment, you're going to have continued gains in wages. So that's critical. The other thing to keep in mind is the data over the past few months in terms of the lower income cohorts of consumers are starting to show that all the delinquency measures which were rising heading into the second half of 2024 have started to roll over and are starting to improve. Yes, some of these people, some of the lower income households have certainly pulled back. That's a healthy thing. And it set the stage for better financial conditions for them going forward. And then you put on top of it the fact that we have a continued tight labor market, a Federal Reserve that wants to continue to keep the labor market tight, and a fiscal policy that spent a heck of a lot of money. You're painting a picture that says sustained upside economic growth, or I should say sustained above trend economic growth, is the more likely scenario than a dip below trend GDP, and definitely a long way from anything weaker than that.
So you're not concerned about stagflation?
No, I'm not concerned about stagflation. I think you could make an argument at some point in time we might have stagnation, but stagflation requires that you have a global demand, excess demand for tradable goods. We don't have that. We have a global excess supply of tradable goods. The underlying service inflation is probably enough, given what we expect to happen in some of the other categories on goods with regard to the currency, are enough to keep us around the 3% inflation rate. And when you look at these PCE numbers, yeah, they're in 2.6% year over year. That's down from 2.8. 1 month does not make a trend. 2.8, 2.6 are a heck of a lot closer to 3 than they are to 2, which is the Fed's target.
And I know you don't see a chance of rate cuts this year, but we're increasingly hearing calls from other folks on the street, including Torsten Slok this morning, indicating that there is an increased risk of a recession. What would change your call on no cuts for this year?
Well, I think the concept is an increased risk of recession relates to the equity market, and the equity market has dipped in here. But you have to understand something. The equity market has been exceptionally robust relative to earnings. And what you're really seeing is a correction in the technology stocks. When you look at the equally weighted index, it's going nowhere. And you look, it's basically flat. So all the concentration is coming down on the Mag 7. Yeah, a lot of the bulls would have liked to see the correction take place where everything else catches up to the Mag 7. But the correction we're seeing in here is actually one where the Mag 7 is coming back to reality, and the earnings numbers are beginning to drive the equity market again, which, to be honest with you, a year ago when the Mag 7 were going through the roof, everyone kept on saying, well, this is a problem. We've got an equity market that's horribly imbalanced. Something has to go wrong. Something has to break. Now that we're correcting, it's like, oh my God, it's correcting. Something has to break. Everybody always has a something have to break argument, and they're easy to make, but the problem is they have proven to be wrong every time since 2002, and we're now on our 7th recession call. And I hate to say it, it's going to be disappointed again, as the previous 6 have been.
Stephen, thanks so much for taking the time here with the reaction to today's PCE report.
Cheers.
Bitcoin continuing to fall down 25% from its all-time high in January as investors flock to safety. President Trump vows to impose tariffs on Canada and Mexico, as well as additional tariffs on China. Let's go now to Yahoo Finance executive editor Brian Sozzi live at Bitcoin's investor conference with Anthony Pompliano, professional capital management founder and CEO. Soz, take it away.
All right, thanks so much, Brad. Anthony, good to see you, host of the Bitcoin Investor Week Conference. Thanks for having us. Brad was talking about this sell-off we've seen of Bitcoin. To the average human being out there watching this slide, I think it's down 27% over the past 6 weeks. What are they seeing?
Well, I don't think that people should really be that worried, right? If you go back and you look at the 2017 bull market or the 2021 bull market, historically we see anywhere between 4 to 7 drawdowns of 30% or more. And so really what we're seeing is just what has always happened. Bitcoin is a volatile asset. That's what people are buying. It's buying volatility. So if you want Bitcoin to go up, you've got to be okay with it going down sometimes. And these kind of cooling off periods or these consolidations are very natural.
This room is packed. I mean, this is a buzzing room. Who's in this room? Is it more retail investors or the institutional folks that I would argue have been driving Bitcoin to new highs before the sell-off?
Yeah, there's about 1,000 people that'll be here today, and really it's a combination, right? We've got a lot of institutional folks, both as speakers, but also every single institution on Wall Street is interested in Bitcoin now. They want to understand what is it, how does it work, what should we be doing with it, and what can it do for our organization. Also, we've got a lot of self-directed investors, and those people really have been buying Bitcoin. They kind of beat the institutions to Bitcoin, and so they want to understand, where are we going from here, and should they be changing anything in their portfolio?
Getting back to that Bitcoin sell-off, Binance's CEO, Richard Tang, has been on fire on X. He thinks this is a tactical retreat in prices. Would you agree with that?
Yeah, look, I really don't think that anyone should be worried whatsoever. Like, if we go back, on November 1st, Bitcoin was $69,000, right? So we're up since the election. But you wouldn't know that if you go and you look at the sentiment online. Everyone loves to kind of freak out. But if you also go and you take a look at other assets, gold is down, stocks are down, right? This is a global liquidity conversation. It's not a Bitcoin-specific thing. Bitcoin just happens to be the asset that is most sensitive to global liquidity. And whenever you get that sensitivity, if liquidity is contracting, Bitcoin will go down. When it's expanding, you're going to see Bitcoin rip to the upside.
What I think it surprised me, Anthony, is I've always come to think Bitcoin is the place where people go when things get a little shaky in the economy. For whatever reason, that's what has happened in the past. We've seen more tariff talk now hitting markets, and we're seeing Bitcoin sell off. Have these assets become correlated? Bad tariff headline, Bitcoin prices have to retreat?
Well, I think that actually Bitcoin is up since Trump got elected, right? So when you think of it from that perspective, people have gone to Bitcoin. He got elected, Bitcoin was a huge winner. $69,000, we ran all the way up to $110,000. And so I think what people are really showing is that they understand his economic policies, they voted him into office, and Bitcoin was a big winner from that. Now this is kind of a consolidation or cooling off, and so what I think we've got to do is we won't be able to answer this question until we get towards the summertime. And so if Bitcoin then turns around and rips right back to all-time highs, we'll say, hey, you know what, that was a consolidation, not a big deal. If Bitcoin stays sub 100K, then I think people will start asking, very different questions.
Early this week, I caught up with Robinhood's co-founder and CEO Vlad Tenev. He said, it didn't sound like we're getting a Bitcoin reserve this year, but we may get a stablecoin regulation. Do you think we get a Bitcoin reserve?
I think we'll get both. Stablecoin regulation is going to be very important. I think we will get that. But I also think that there's very different forms of a strategic Bitcoin reserve. We can hold the 200,000 Bitcoin that we have and just say, hey, we're not going to sell it. Technically, that'll count. I don't think that's what people want. I think people want the United States to go and buy Bitcoin. And the question is, what is that process? Can it be done through executive order, or are we going to have to go through kind of the legislative process, which will be much harder and may not happen this year?
Bitcoin reserve, where does Bitcoin go?
Much higher. Yeah, I mean, look, anytime that you look at kind of these new pools of capital entering into the market, usually there is some initial, buyer that provides career cover for everybody else. So you saw Paul Tudor Jones and Stanley Druckenmiller do this in 2020. They came out and said, we own Bitcoin. Every portfolio manager on Wall Street could then go buy Bitcoin. When you saw BlackRock and Fidelity come out and say, we're going to have an ETF, every single financial institution, they're in the game. If the United States of America starts buying Bitcoin, every country in the world now has the cover to go and do it the same. And so it's not just a U.S. story, it's going to be a global FOMO story, and I think that pushes the price much, much higher.
Should meme coins be securities?
Well, the SEC, who's much smarter than me on these topics, they say no.
Are they?
What I think is probably an interesting second or third order effect is if you now have a digital collectible that's not going to be a security and they look like these meme coins, I think you're going to see a lot of other asset issuers say, how do I take my asset, put it into a digital form, and have it fall under this digital collectible kind of rulemaking? What the effects of that are, I don't think we quite understand yet, but anytime that you can show some of the incentive, you can pretty much understand what the outcome's going to be. And so now you're going to have these digital issuers saying, oh, I'm just a meme coin, I'm just a collectible, please don't regulate me. On one hand, it'll be lower costs for them to operate, which I think is what they'll be going after, but also I think that there's a reason why securities laws exist, and we want to be very careful about that.
All right, let's get, after this conference, I think you got to go sign some autographs or something. Anthony Pompliano, good to see you. Talk to you soon.
Thank you so much.
All right, Brad, back to you.
All right, Anthony and Brian, thank you both so much for joining us. Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we'll check in on shares of Nvidia. That's selling persisting after earnings, though the shares popping around a bit this morning. Also, Meta going all in on AI. What does that mean for the company's stock performance? We're going to discuss that and much more on Morning Brief.
Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we're tracking shares of Nvidia, the market cap falling below $3 trillion after the chip maker's fourth quarter results failed to wow investors. Yesterday's steep drop wiped out about $273 billion in value. Nvidia first hit a $3 trillion market cap in June of 2024. Taking a look at shares here this morning, adding on to some of the declines that we saw on yesterday's trading activity here and lower pre-market by about 2%. Now, for anyone who was tracking some of the options contracts coming into this earnings report, yesterday's move lower should come as no surprise. We were talking about it even going into, and I had mentioned an 8.5% drop was what those options contracts were pricing in. That's exactly what we saw yesterday. In terms of what we could potentially see investors try to focus their attention on from here, I saw Yahoo Finance's Frost Superman had a story up about the auto business and how that essentially doubled. So one of the bright spots, at least last quarter. But then moving forward, it's also going to be about the margins here and ultimately seeing how Nvidia can extract even more margin from its customers. And some of those customers are trying to figure out how we're going to be able to cut some of the costs around the generative AI and inferential computing that's going to be coming forward.
Right, that's what we heard from the likes of Dell, which I know we're going to talk about in a second here. But I thought it was fascinating to see the price action on Nvidia after those earnings, because we saw the stock whipping around a little bit, right? There was a moment where it was up about 2% around the market open on Thursday, and then around 10 a.m., you get some headlines from the Trump administration about export controls and tariffs, and then you start to see this sell-off coming up here. So is the policy driving the price action on Nvidia? That, of course, remains to be seen. What we do know is that this was the worst post-earnings day for Nvidia since 2018. That was before the AI of it all. That was when gaming was the primary business for the company. So this is a very significant sell-off. And if you take a look at Wall Street Bets Reddit this morning, you got a lot of traders who are really feeling the pain today.
Back in the days of the GPU business, taking up all of the air.
Yeah, exactly. They're wishing for those days again. And you know, Nvidia typically has a comeback story after those earnings, and we'll of course continue to cover all of those moves. But let's move on here. HP's profit outlook for the current quarter falling short of expectations as the computer company expects to take a hit from tariffs on goods from China. Yahoo Finance executive editor Brian Sozzi spoke to HP's CEO about the potential impact on prices. Take a listen.
What we have shared is our recipe to respond is first, to rebalance our install base, second, to look at additional cost, and eventually, if we have to, we may look at prices, but we put that the third in the list because we want to protect our customers, we want to protect our consumers.
HP also planning to lay off up to 2,000 more employees this fiscal year, and you can see here the stock down over 4% right now. Their adjusted EPS coming in short of estimates here and coming in at 75 cents versus the 85 cents that were expected. Just to run through a little bit of the analyst commentary here, Morgan Stanley noted that the company's guidance moving forward feels a bit too ambitious given many market uncertainties, and I think that is a covert mention of the Trump administration policies. And we continue to hear this kind of back and forth from the market on whether or not Trump's policies are actually going to weigh on stocks. But when it comes to individual names, a company like HP, it does seem like not only the tariffs on China, but also export controls could be a headwind for them moving forward.
Yeah, one of the other notes out this morning that was from UBS. They essentially moved their, and they have a rating right now of neutral, $37 price target. David Vogt, he was actually out with two different calls here this morning, both HP and HBQ, so separate HP entity. But then additionally on Dell, which is another kind of in tandem happening around HPE, looking past this larger reset taking place here as we're taking a look at shares down by about 5.7%. Their target there on a buy rating is $150. That is actually lower though from the 158 that they had previously, and said they are looking past the fiscal year 2026 reset there and expect non-AI end markets to recover in fiscal year 2026. So there you're seeing that move on shares of Dell here this morning too. Finally, we got to talk about Meta. Meta reportedly planning to launch an AI app in the second quarter of this year as it looks to compete with OpenAI and Alphabet. Meta also plans to test a paid subscription for its AI services. You're taking a look at shares of Meta up fractionally pre-market. Now, what was also rattling around social media last night was this posted video of a clearly AI version of Mark Zuckerberg as Sam Altman is kind of putting the warning shot out there for some of the existing social media companies, saying he's ready to also launch a social media app too.
I mean, what matters is who's going to get the most money for it, right? And what I think is interesting about this announcement from Meta is that they are going to plan on charging people, having a paid subscription with additional AI features. The pricing is unknown. And according to some reporting over at Reuters, a source in Meta said that that subscription service will begin in the second quarter of this year, but the company does not expect subscription service revenue until next year at the earliest. So come this time 2026, Brad, which of these companies is going to have the best balance sheet when it comes to ROI on AI spend? That's the key question in my view.
Right, whichever one makes the best free experience first.
Right.
That's what it's going to come back to. I mean, let's think back. When we were beginning the search and the ranking that Google rolled out en masse and was able to make free for everyone who could have access to an internet, you weren't saying, oh, how much are you paying for your Google experience?
Yeah.
Nobody was talking about that. You're saying there's this free service online. All you got to do is go to google.com and essentially type in whatever you want to search, and it'll spit back to you in fractions of a second, microseconds, what exactly you were potentially looking for, whether it was based on an encyclopedia reference. All of those things considered, that same mind share or mental capacity for how people are thinking about the next wave of technology with regard to any type of generative AI is going to have to come with a free option.
Yeah.
There are still people who want free streaming services.
Right, that's true.
And we needed to see good free streaming services until they were then eventually monetized. So when we're looking at the growth cycle for a lot of these companies who are trying to say, oh yeah, we're going to roll out a monetized app or a monetized option, it's going to come back to how well they get free correct out of the gate. And then from there, how they're able to make sure that the monetized experience also adds on incremental value.
Right.
Otherwise, nobody's going to want to buy into that and pay for it.
Right, I just started using ChatGPT 2 years ago.
And are you paying?
And now I have to pay for it already. You made a great point about, the timeline from when we were getting really affordable streaming services to when they started to raise prices was a little longer than the timeline we're working with at the moment. So it's going to be interesting to monitor those price hikes for sure moving forward. But we are minutes away from the opening bell on Wall Street. We're going to be right back with more coverage after this.
We're taking a live look at the opening bell at the New York Stock Exchange and at the NASDAQ in Midtown Manhattan. Yeah, go ahead, press that button, get some funfetti. And at the New York Stock Exchange, you've got the U.S. Customs and Border Protection Department ringing the opening bell there. All right. As we begin today's trading activity, let's take a look at the major averages just after the opening cross. We're taking a look at the Dow right now. That begins the day higher by about 0.2%. Of course, big PCE energy out of the gates here this morning. We're continuing to track, though, the S&P 500 trying to find its way as that's in a kind of hyper waffle phase out of the gates at the opening cross. And the NASDAQ composite, I believe that's calibrating for us here. But ultimately, as we're continuing to kind of pair that up against this week, let's populate this line graph for you here. We heard you like line graphs, so we got a couple of those for you. We'll take a look at the past 5 trading sessions. We are still net lower by about 5% over that period, and I believe this has calibrated. We've calibrated lower. We're down by about 0.3% to start off today's trading activity for the NASDAQ composite here. And then additionally, taking a look at some of the sector activity out of the gate this morning. I want to load up some heat maps here where we've got staples leading the pack as of right now. XLP, that's up by about 1.2%. You down with XLP? Yeah, you know me. All right, well, anyway, XLE, that's pulling up the caboose. Right now, that's lower by about 0.5% here on the day. And then lastly, let's ride out with a quick look at the NASDAQ 100. You've got quite a bit of red, but hey, you've also got a lot of gainers here. Let's put this on an equal view just so you could see how that split. Yeah, we definitely got way more gainers than decliners here, but bringing up the caboose, and this one's noteworthy. We're going to talk about this one in a hot second. Palantir, that's lower by about 6% to start off today's trading activity here. That is a deep, kind of slash shallow tease for what we're going to dive deeper into in just a few moments here. But you've got Monster leading the pack here. You've also got GFS. We don't see that leading the pack very often, but that's starting off the day higher for Global Foundries by about 2.2%. All right, you can take some time, dig into that further, or you could stick around and listen to Jared Blickery because he's going to take a deeper dive into what's moving out of the gate this morning. Hey, Jared.
Hey, Brad, we got some monthly, mostly losers here. I wanted to say winners, but let me just go through some of the stats, and I have a lot of stats. First, I'm going to dial up a 19-day chart because that is how many trading days hath February, I guess, as the old rhyme goes. So you can see the Dow is down 2.65%. That's not too bad, but then we get to the S&P 500 having its worst month since April of last year. That's down 3%. And the NASDAQ and the NASDAQ 100, both of those in the same camp. NASDAQ Composite down 6% and the NASDAQ 100 down 4.76%. Both of those having their worst month since September of 2023. So we're going to get some dates that stretch pretty far back in time here. I can also go to the 10-year T-note yield. That has had that was coming in the right way with supporting risk markets. That is down to 4.25% right now. It has had its biggest drop since December of 2023, and the U.S. dollar, which tends to move in the same direction over the long term as yields, at least recently, that is down about 70 basis points, which really isn't a lot, but that was the most to have it fall the most since August. It has been on the rise recently. And then we can go to our sector action. And I've been tracking the relationship between staples and discretionary. So consumer staples, the stuff you need, discretionary, the stuff you want, and they have been at opposite ends of the spectrum. Here again is that month-to-date look, and you can see XLPs. That is in the lead, followed by real estate and energy, and then really far and away, just plunging to the downside, XLY down almost 9% there. Tech also an underperformer, that is down 5%. And we can really see this playing out in the NASDAQ 100. I'm going to leave on this month-to-date time frame, just a few hours into the close here. But for the entire Mag 7 index, this is the worst month since April of 2022. And in fact, this bull market began somewhere around October of that year. So this goes back into that bear market. And I think that's pretty significant. So not only the Mag 7, but Tesla and Amazon also having that worst month since April of 2022. And I'll just show you a couple charts here. Alphabet also not doing well. Let's go to the month to date for that. And we can see it is down 18%. So some pretty significant movements here for the big guys, the generals. You can see Tesla here that I'm circling. That's down 32%. And even Meta. Remember, Meta had that 20-day winning streak earlier in the month. That is having its worst month since July of 2024, and I'll show that real quick, down about 6.64%. I'm going to close here on Bitcoin because that is really stealing the show as far as headlines. That is down 16.6%. Let me do a trailing 1 month here, down 20%, and that is the worst month and week since 2022. Here is the 19-day. Let me just show you a year-to-date so you can see down 13.9%. I've shown this chart quite a bit. We broke that topping formation that we have, and it looks like we're heading right back down, maybe to 70. I don't see a lot of support at 80, 81. But on that note, I'll send it back to you guys.
All right, Jared, thanks so much for tracking those moves for us this morning. It's time now for today's strategy session. The bond market seen its biggest rally since July, with the 10-year dropping to around 4.2%. But as investors digest the latest read on the economy, are these gains sustainable? Joining us now to discuss, Janet Rilling, Allspring Global Investments Senior Portfolio Manager. Janet, great to have you on. As you know, the 10-year yield on track for its 7th week of declines. What is the price action telling us about the health of the economy?
Morning. Yeah, I think that the bond market has been watching the fiscal headlines pretty closely and trying to understand what the second order impact is. And given there's a large degree of uncertainty, I think that is weighing on the view on economic growth. We are still constructive on growth for this year and think it will be positive. But given the uncertainty, we know that corporate leaders are starting to slow play some of their strategic decisions, maybe merger and acquisition activity, maybe CapEx investment. And that does lead to a lower view in terms of growth outlook.
And so what do you think a better estimation or a better kind of outlook for that growth is potentially kind of more tempered at this point?
Yeah, I think still achieving 2 to 2.5% growth is possible, but that is a deceleration from what we saw in 2024.
To what extent do you think that policy from the White House is driving some of that movement? I've heard sources arguing on both sides of things, that the policy is just noise. The slowdown was already in the market prior to that. That's what Neil Dutta has to say. Whereas others say that the tariffs and the sequence of policy, with tariffs coming first prior to tax cuts, is going to weigh on growth. What do you think?
Well, the direct impacts from policy are not yet in the numbers. We are still waiting for some of it to be implemented. It then takes time to work its way through the economy. So I think the effects we're seeing now are more on sentiment, the anticipation of what the tariffs mean, and then also from the consumer standpoint, maybe a bit more uncertainty. I mean, the job picture is strong for the consumer, and a consumer tends to spend when they have a job. But there is an increased level of uncertainty. I mean, if you think about DOGE and some of the cuts in government, while many of the government workers will retain their jobs, it has increased uncertainty for them, and they may cut back a bit on spending. So I think just this level of uncertainty is impacting not only corporate decision makers, but consumers in their decision making. As we get a little more clarity on policy, that may take that element off the table. However, we will then start seeing the effects of the actual implementation. And I will say, it's not clear that these policies will have a negative impact. They are complex. They some may add to economic growth, others may detract. And so it's a really uncertain environment when you try to net all these items out. And in our view, just a little too early to have good clarity to predict.
It seems like the consensus is that the policy will still have and some larger kind of implication for volatility. And with that volatility, We've heard calls, even from UBS this morning, saying it's time to be bullish, acknowledging that the volatility is going to stem from that policy and the will they or won't they of tariffs, and then what will that do to the economy, and then what will the Fed do? What, from your best gauge, is the best kind of animal spirit for investors to employ right now?
Well, first of all, from a fixed income standpoint, we do think now is a good time to allocate some of your portfolio to fixed income. And that's because the overall level of yields is higher than it's been for quite some time. In terms of the volatility, we do think it's going to be elevated because the range of outcomes is wider than it's been for some time. But that said, you can take a longer term view, set your allocation, and then shift your portfolio in an active manner to the sectors where there's a bit better valuation. So for us, we're emphasizing, for example, structured product in our portfolio. Here, we think the valuations are a bit better in the current environment. But it's this idea that you do want to have the longer term allocation to get that ballast in your portfolio. Duration serves at times as a cushion to equity market volatility. And we think having that foundational allocation in an investor portfolio is important.
Janet, thanks so much for taking the time here with us just after the opening bell. Appreciate the insight.
Thank you.
It's time now for our chart of the day. And today we are taking a look at shares of Palantir. This chart here showing the number of retail traders buying into the stock at a time where company insiders are selling. Notably, CEO Alex Karp this week selling $44.6 million worth of shares. Now, of course, executives do have to disclose what their share selling plans are. His is one of the more recent, especially for a name as large as Palantir that has played out within the retail landscape over the course of, I would say, the better part of the last year here. There seems like there's been a lot of social chatter on Palantir, and as we're measuring by some of the inflows here, that certainly has kind of mirrored what we've seen on the spending propensity, or at least those who have looked at shares of Palantir and identified what their entry point is.
Yeah, it's a significant story when it comes to Palantir because of just the run-up that we've seen and then this fall to the downside. I'm hearkening back to my Bloomberg days when one of my co-anchors would put me through a weekly quiz on what the best and worst performers were for the S&P 500 on the week. And taking a look at this week, Palantir is one of the worst performers, just a couple of stocks performing worse than them, including the likes of Vistra and Super Microcomputer. So that's significant when you think about the run-up that Palantir has had, and now they're coming off of those highs. The question is whether or not that's just a little bit of profit taking or whether it's something more sinister. And the reason we wanted to show this chart on retail interest in the stock is because there is this idea that when retail investors coming in, that is the quote unquote dumb money. We would never call our retail investors dumb, but this is just an idea on Wall Street. When the retail dumb money comes in, smart money leaves. And you are seeing that insider share selling at the same time. So is that an indication of bearishness to come for Palantir? That is the question that a chart like this raises here.
We are going to reframe the term dumb money
Yes.
within the next, we're gonna do it. We're gonna workshop it here.
We'll come up with something in the break.
Just because you don't have as much as some of the institutions and some of the insider traders.
Yes.
Yeah.
I agree with that.
We can be their marketing team.
Yes, yes. We will rebrand the movie Dumb Money as well. We'll come up with a better title for that. All right, coming up, we're talking to the CEO of Duolingo after the company's latest earnings results. Stick around for that conversation next. Shares of Duolingo taking a jump to the downside here, down about 16% this morning. Now that comes despite the company's fourth quarter revenue beat, driven by 51% increase in daily active users and a 43% jump in paid users year over year. Joining us now with more on what's next for the company, Luis von Ahn, Duolingo's CEO. Luis, thank you so much for joining us this morning. There was a lot of good news in the print. You had a beat on the top and bottom lines and strong guidance, but the street is clearly disappointed. What do you want to tell investors?
Well, we're generally very excited about everything that's coming up. In particular, we have historically we've had the free version of Duolingo and also the premium version called Super Duolingo. Over the last, call it, year and a half, we've started adding a new higher tier called Duolingo Max, which is getting really good adoption. It's about twice the price of Super Duolingo, and what it has really good AI features that help people practice conversation, and we're seeing really good adoption on that. And so, we're very excited about that.
what are some of the expectations for growth that you have going out this year, and that would really point to some of the ultimate number of users that you have opting into that max feature as well?
Yeah, I mean, our growth, first of all, we're growing in every region. We really are, every single region has high growth rates. And one thing that's really interesting is that even regions that are pretty mature for us are still growing fast. So we think there's a lot of room for that. And then there's a lot of room for people to subscribe to Duolingo, Super Duolingo and Duolingo Max.
Well, one of the things that's interesting and that the street is disappointed with this morning is the margin pressure, which is caused in part due to your strategic decision to invest a lot upfront in AI and then hopefully reap the benefits of that later on. Given the stock price dip that we're seeing today, do you regret that strategic decision?
Look, we're in a unique point in time with artificial intelligence. We have decided that we're going to invest, particularly the first half of this year. We're going to invest quite a bit on making much better features that are related to AI to teach better. In general, I think this will open up a lot of things. For AI, there are two big parts where we invest in AI. There's one which is creating content that is actually cutting costs, and we really like that. But then there's the part that particularly has to do with conversational practice. There, we're not even trying to save costs right now. We're using the latest models because we want to develop as good of a feature as possible. And we know that over time, we're going to be able to decrease those costs, not only because the models themselves are going to get cheaper, but we can also optimize. But at the moment, we're just trying to go as fast as possible with that.
Luis, I enjoyed my days growing up, taking French classes. Now, as an adult, I must admit that my French is, at best, masterfully bizarre and sporadic. At this juncture, though, there is so much AI and artificial intelligence out there that has removed the need for a lot of younger people and people who are just trying to get into learning a new language to feel like they need to learn it. So how are you kind of combating the threat of AI and analyzing how the business is going to ultimately go up against some of the other major tech companies who are just saying, hey, we can integrate this into an experience that we already have where we know we have an install and a user base?
Yeah, in terms of learning a language, we're not particularly worried about that. We have, our users fall into two big buckets. One is hobbyists, people who are just learning a language as a hobby. Whether, AI can have immediate translation or something like that doesn't matter for people who are learning as a hobby. A good example is with chess. Computers are better at playing chess and have been for the last 20 years, but people still learn chess. And then the other big bucket of users that we have are people learning English. And people who are learning English want to learn English, and they're going to want to learn English regardless of whether a computer can do immediate translation or not. So that is not something we're particularly worried about.
It's interesting in the context, though, of what you were talking about previously, which is this focus on investing in AI upfront in order to have gains later on. I know that you don't currently plan on charging additional fees for your AI offerings. At what point do you sit down with your CFO and say, okay, we got to get these margins up. We got to start charging more for these AI offerings like those video calls that you have on platform?
I mean, in general, our margins, we have, over the last couple of years, our margins have expanded massively. I mean, we really were basically break even, and by now we're at like 25% adjusted EBITDA margin. So we've done pretty massive margin expansion over the last 2 years. We're still going to expand margins this year, but it's just going to be a little slower than previous years. And mainly it's because of this investment in AI. I think it's the right thing to do at the moment.
I want to just enjoy a question with you at the end here, Luis. Me, like so many people on the internet, are obsessed with Duolingo's social media presence. And just as a CEO, I'm just curious, are you meeting with your social media leads weekly? What does that look like? Operationalize that for me and talk to me about how you have strategically thought about rewarding your social media team given their success.
Yeah, look, we have our owl mascot decided to fake his own death because he really wanted to get the attention of Dua Lipa, and he also wanted to get people to do their lesson. I didn't know he was going to do that. This is what happens when you hire creatives like the owl. They have a mind of their own. We've talked to him. He's not going to fake his own death anymore, and we've also convinced him not to do illegal things going forward. But we have a loose cannon there with the owl.
Wow. A fictional owl doing illegal things. Louis, we have really kind of going into a deep humanization of our mascots out here. Thanks so much for taking the time here with us. We'll continue to track the stock price reaction and the brand story going forward. Luis von Ahn, who is the Duolingo CEO. Thanks so much.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's go. First up, Autodesk beating on the top and bottom line in the fourth quarter and providing strong guidance. For 2026, the software firm sees adjusted earnings per share, that EPS, of $9.34 to $9.67. That is well above the estimates for $9.23. The lower end of the revenue guide meeting estimates as well. The company also announcing plans to cut 1,350 jobs in order to focus on profitability. RBC Capital calls the 2026 guidance bullish. KeyBank touting the firm's operating margin, free cash flow outlooks, as well as the restructuring plans.
Plus, Rocket Lab plummeting after delaying the launch of its Neutron rocket to the second half of the year, falling short on revenue expectations for Q1, seeing $117 to $123 million versus estimates for $136 million. Wall Street is mixed. TD Cowen putting its price target under review, KeyBank lowering the target, but analysts also argue it may not matter so much to the long-term story. Citi saying they haven't come across a space program that has not been delayed.
Yeah, true. Finally, Monster Beverage rising after topping gross margin expectations in the fourth quarter. Revenue essentially in line with estimates while adjusted earnings per share missed. JP Morgan highlighting the constructive tone of the conference call, seeing optimism for recovery in the U.S. while acknowledging January performance was impacted by weather events and the California fires. Morgan Stanley is expecting rebounding category growth and positive impact from price increases, while Truist remains skeptical of long-term growth in a mature market with increasing competition. All right, that does it for Morning Brief. That's it for the 9 a.m. hour, but you can join Maddie in the next hour for more analysis on Catalyst and myself at 11 a.m. for Wealth. You're watching Yahoo Finance.